Welcome back, ladies and gentlemen. My name is Joshua Castillo. If this is your first time checking out the channel, welcome. I'm a value investor. I like finding new companies. I like looking at other value investors. I like investing in everything about the financial markets. So if that's something you're interested in, hit the subscribe button down below for more content. I try to put out content as often as my schedule allows. So it's not consistent every week to week, but I really try to put out more content. And I've been trying a lot more these last couple of weeks. So with that being said, diving right into what we're going to be looking at today. If you couldn't tell from the title already, we're going to look at Revolve Group's earnings. They just had their Q2 2023 earnings come out, and I think that this is a company that I really like. I like the management team. I like everything that they're doing. I like the product. So with that being said, let's dive right over to the PowerPoint presentation where we can see this further. We can actually take a look at what they are doing. Now, this should go without saying, but I have a position in this company. This is not financial advice. This is just what I'm seeing and what fits me in my own portfolio. If you're going to look at this company, do your own due diligence. The reason I show these companies and these earnings and what I'm doing is more so just to spark ideas, and maybe you have an idea that I haven't thought of yet, and that might come through the comments or come through a DM or something like that. So that's kind of the goal of putting this stuff on social media. That being said, let's take a look at Q2. So this should be a relatively easy video to follow. I'm just going to go over the financial statements, going to go over some of the things that were said on the earnings call, some of the Q&A that came through as well, and then anything else that they presented for this kind of Q2 2023 wrap up. So the thing is that looking at the balance sheet first is what we're here taking a look at. The company remains debt free. Now they do have non-current lease liabilities, but as far as like quote unquote actual debt, they don't have any debt on their balance sheet. Now, again, you can consider non-current lease liabilities a long-term obligation, but again, it's not considered long-term debt under what the balance sheets and GAAP kind of require. So, but looking at this though, you can see that their cash and cash equivalents have gone up over the half year, last 6 months. That's what we're looking at. They did have a Q1, but the balance sheet only shows Q1 and then Q4 of last year, so what they ended 2022 with. So they are increasing their cash and cash equivalents. Their AR is also increasing as well. As you can see, the best part about what we're seeing, and we saw this in the last quarter as well, is that their inventory is actually ticked down from the end of last year. So they're trying to moderate their inventory based on the demand, based on the sales that they're making, and actually what is coming across in their earnings. So that is why you see that inventory tick down. Keep going. We have down below, you can see that they're accruing some expenses as well as their returns reserve has gone up. They do talk about the returns quite a bit in the call. So that is something you want to pay attention to, is the returns and kind of how that impacts the financial statements. But for more information on that, go through their quarterly earnings from this quarter and last quarter. Going over to their net income statement, net sales was $273 million, a year-over-year decrease of 6%. Gross margin was 54%, a year-over-year decrease of 198 basis points, primarily reflecting a lower mix of net sales at full price in the second quarter of 2023 as compared to second quarter of 2022. So they're doing a little bit more promos this quarter. Net income was $7.3 million, a year-over-year decrease of 55%, primarily due to the decline in net sales, reduction in gross profit year-over-year, and continued pressure on certain operating expenses. So again, looking at these 3 months and the 6 months, you can kind of see where that pressure is coming from. Fulfillment is obviously going to be a big piece of what has gone up, as well as kind of the selling and distribution. Now, those two things combined are going to make up a majority of what these cost increases have come from, and a lot of it has to do with the fact that gas has gone up. The people actually working in these warehouses, working the distribution has gone up, returns and things like that. And, the cost of receiving a return has also gone up. So a lot of the inputs into their business model has gone up on the OpEx side, but they have decreased their marketing slightly and the G&A as well. So there is some counter to that, but you can see year over year, the operating expenses isn't that far down from where it was last year, relative to the gross profit that you can see above, where the cost of sales has ticked up quite a bit. And obviously, as they mentioned earlier, the net sales have ticked down quite a bit. So that's going to be relative to where and what this company is doing. It's something you want to pay attention to because, obviously in 21 and 22, people had stimulus. People could buy things at full price. They weren't waiting for promotions, versus now in this current environment that we're seeing, a lot more people are taking advantage of promotions, taking advantage of things that they they want to do, and really taking the money that they currently have and choosing a little bit more, versus when we had stimulus checks and things and big tax refunds. That was a big impact to the business's top line. Moving on over to the cash flow statement, slight increase year over year to the net cash provided by operating activities, as well as a slight decrease in PPE spending. Now, the purchase in property and plant and equipment, that section of this has remained, I don't even want to call it down a little bit. It's probably by the end of the year going to be more or less the same. This company doesn't require a lot of build out unless they invest more into their fulfillment and distributions, what they have been doing internationally. So if they continue to build out the fulfillment and kind of distribution and selling, you'll see a little bit tick up in that OPEX piece, or in the CAPEX piece. But when you're looking at the kind of net cash provided by operating activities, this quarter actually was negative. I think it was like 15 million, 14 million. But it was negative for the quarter. But overall, the net cash provided by operating activities for the first 6 months of this year is 34 million. So a slight increase versus last year. But again, you're going to kind of offset some of this stuff with the other items that they're adjusting out. And something to note as well, and I'll mention this a little bit more. Next quarter at the financing activities, we'll probably start seeing some buyback activity and how much they're actually spending. So I'm excited to see that, but I'll mention that here in a second. Going over to their kind of earnings presentation and what they had, obviously, as I mentioned earlier, they had a year-over-year decline in net sales. Now, on the earnings presentation and in the 10Q, they broke it out by segment. That's how they do a lot of their reporting. So you can see the year-over-year decline on the Revolve side was 400%, and the decline on the Forward side was 15%. Now, Forward serves a higher-end client than Revolve does, a higher-end customer. So it's not really surprising, given where we're at with the macro, that Forward is down a lot more than Revolve. Granted, it's not good for the business in the short term, but they think that this is short-term headwinds, and I think it is as well. So it'll be interesting to see what happens next quarter, kind of the coming quarters, because obviously, again, you're comparing to 2022. So there is that built into the numbers as well. Year-over-year increase / decline in Q2 net sales by geography. So the United States, negative 7%, was offset by, partially by the 4% increase in international. Now, it's interesting to me how this international piece is going to continue playing out. You can see on the right there, 81% of the business's net sales came from the US, and then 19% came from international. And they don't break out what countries, what percentage of that geography for the international is due to which country. I don't think it's material enough yet for them to break out a country, but I'm sure as things tick up on the international side, you'll probably see them break it out more, or start to break it out as this becomes more significant to them. Operating metrics, again, by the net sales, the gross profit, and kind of the breakout. This is just to show you the actual dollar amount that we were talking about earlier. So Revolve net sales from 2023 was 235 million versus 2022's 244 million last year. Forward, 38 million this year, 45 million last year. And you can see on the 6 months ends as well, it was more or less the same. So tick downs on both segments. And again, that led to the tick down in top line on the quarter as a whole. Gross profit, again, ticking down as well for both the quarters and for the 6 months. The cost of sales has obviously gone up quite a bit given the macro, so it's not that surprising, as well as the consumer isn't spending as much, or is being a little more choosier as to what they spend money on, and returns have gone up as well. So all this kind of boils down to, it's not like a fantastic environment, but it's not terrible relative to where I think we really are. So I think they're doing the right thing. It's just a matter of matching up your demand, your inventory, and your sales with the consumer and what their actual demand is as well. Again, at the bottom, you can see there, United States was 222 million versus 240 million last year, and the rest of the world, so the international, was 50 million versus 49 million last year. So you can see that, honestly, geography-wise, they're picking up. You can see the 6 months there is also picked up as well. Obviously, the United States has ticked down quite a bit on the 6 months, as we mentioned earlier. But still, it's nice to see kind of some of that ground being made up by the international market. Moving over more so to the kind of operating metrics side and kind of what they are focused on as far as like KPIs and what the indicators are. Active customers is probably one of the biggest things that you want to pay attention to, because that means that the business is actually still growing. People may not be spending as much, but the amount of people shopping there over the last 12 months is what is increasing. So active customers, which is a trailing 12-month measure, increased by 34,000 customers during the second quarter. This growth expanded our active customer count to 2.5 million, an increase of 14% year over year. In the near term, we expect further moderation in quarterly growth of active customers. So again, you can see there Q2 2019 was 1.3 million versus Q2 2023 is at 2.5 million. So that's a pretty good gain over the last 4 or so years. And I'm pretty happy about that. And you can see at the bottom there that quarter over quarter growth, which is important as well. So it says our customers placed 2.3 million orders in the second quarter, an increase of 1% year over year. So again, moving on to that next column, you see the total orders placed back in Q2 2019, 1.2 million versus Q2 2023, 2.2 million. So year over year, pretty good stuff to hold that ground. Obviously, you want the orders placed to be ticking up. That's obviously where the sales are coming from, and that tick down in growth is really what you're seeing on the net sales side. Surprisingly, the average order value didn't fall that much from last quarter or from last year. It's slightly down, but $301 is the average order value, which has remained, above 250 has remained pretty stagnant over the last couple of years. So I'll take what I can get out of that. Obviously, given the environment we're in, $300 is not anything, bad. It's just a matter of the orders placed and getting that to tick up on the marketing side. Will be interesting to see if they decide to churn through that with promotions or discounts, or actually just try to get full price net sales. Looking at this on kind of a number basis, again, you can see over the last 3 months, gross margin was at 54% versus 55.9% last year. And again, you can see the 6 months as well. That tick down in gross margin is, again, the big piece in all of this. Adjusted EBITDA, 10 million versus 26 million last year. You can see the 6 months there. Free cash flow, again, negative 15 million versus negative 30 million last year. The 6 months mark is 32 million versus 21 million. So a tick up in free cash flow overall, but again, a negative quarter in this quarter. So active customers, we mentioned earlier, total orders placed, as well as average order value. This table is probably one of the most important tables as far as looking at this business and kind of checking the health and seeing where it is. These are the things that the management looks at, and these are the things that I look at, and these are the things that if you're going to look into this company, this is something you should keep track of and kind of put on a spreadsheet and track over time. I think it's a really important metrics to track. Now, shifting over to the earnings call, this is going to be the opening statements and then some Q&A after. So the first things first, you have Mike, who is one of the co-CEOs, and he kind of opening remarks, and he said, shifting to international expansion, we recently appointed our first ever head of Greater China to further strengthen the foundation for future expansion in the region. We plan to further build out our local team on the ground in China to expand key relationships and brand awareness, which is important since the marketing and social media channels in China are different than in all other markets we operate. Considering the size and importance of China e-commerce market, we believe now is the right time for us to invest in a more meaningful way to illustrate our growth potential in China. I'm excited to share that Revolve was the number 6 ranked fashion brand on Tmall Global Marketplace during the month of June. This recognition and success contributed to our continued growth in China in the second quarter, and it illustrates the level of interest in Revolve in this very large market. To me, this is one of the biggest opportunities that I think that they have. They did mention, other countries and kind of where the softening was happening versus where the strength was happening. It seemed like Mexico and China were kind of like the big outperformers versus you had like Canada and a lot of European countries were a lot softer this quarter. So it's important to note what the next opportunities are for the company. And honestly, to be number 6 on the ranked fashion brand on Tmall is fantastic. And if you know anything about the China e-commerce game, Tmall is a very big component of China's e-commerce, and to be ranked number 6 on the fashion brand is really, really, really good. So I'm excited to see what they're going to continue doing. Obviously, we'll get more information as the quarters come, but from the international expansion, I would not be surprised to see in the future that they break out China as like a country and where things are, sales are being made. I think China will be a big expansion opportunity for them, and I think that when they expand their fulfillment and distribution centers into Asia, you'll see more opportunities for them to be able to make either promotions or discounts or some sort of deal with the Chinese market that everyone will really get to enjoy from and be able to buy product from this company. Moving on, you had Jesse Timmermans, who is the CFO. She said, starting from the top line pressure we experienced in the second quarter has continued with net sales for the month of July 2023 down mid-single digit percentage year over year. We believe the uncertain macro environment continues to weigh on our customers' purchasing behavior and consistent with the second quarter results. During July, year-over-year net sales comparison in the Revolve segment continue to outperform the Forward segment, and year-over-year net sales comparisons for our international business continue to outperform our domestic business. So I'm going to jump really quick to the consumer sentiment from Michigan just to see where we're at in the United States. So if you've never seen this chart before, University of Michigan actually does a consumer sentiment survey that they do monthly. It's a really important survey that a lot of people keep track of because it really gives you an idea of where is the consumer at, what is happening, and kind of where are we in this sort of cycle. So if I go back to around the 2000 mark, I think this is 2001, you can see that kind of leading into the bull market after the dot-com bust, there was a lot of consumer sentiment. It dropped down to the lowest point, 74.2. And then obviously when great financial crisis started ticking up, you can see people's consumer sentiment obviously went down. So kind of jumping ahead to where we're at today, you can see again, following the bull market that we were in the last decade before COVID, you can see it ticked up all the way to almost 100. In 2020, slightly above 100, and then obviously COVID happened, and it's been down ever since. So between COVID happening, you had government basically rug pulling the economy, as well as people losing jobs, people losing houses, or just people getting sick. It's just a whole lot of things that happened, obviously. So the lowest point it hit was in July of 2022, where inflation was basically ramping up to an incredible amount. And so from July 22 and 50 is where we're hit at the lowest, versus now we're at 64.4. So 64.4 is not a terrible number, but relative to where we have been in the past and kind of what they were talking about here, Jesse again mentions that the consumer's purchasing behavior is, the macro plays a big piece in this. So again, it's a luxury brand. People buy these products when they have kind of like excess money or feel like they have excess money to spend. So that is something that you want to keep in mind as a risk for this business. Moving over to the Q&A, this is the end part of their consumer call. And again, I get this from Seeking Alpha, so if the transcript is wrong, it's because the download is wrong. I didn't write this, and neither did them. Some companies put out their own Q&A transcript, but Revolve doesn't. So Randy Koenig said, Anna, can I ask one more follow-up here just on the commentary around the younger demographic trends? Maybe give us a little bit more color on what they're doing or not doing, or in terms of price hesitancy, category changes, or there. Just give us a little bit more flavor what they're doing or not doing in terms of shopping behavior. I felt like this was pretty important, and it kind of points to what I had just mentioned about the consumer sentiment. So Mike, co-CEO, said, so we've seen is certainly there's a lot more caution in terms of discretionary spending. Last year, they were feeling great and bullish about the future, very excited to engage in the world after COVID lockups, and also a lot of them refreshed their wardrobe. There's kind of cycles there. So we're seeing a bit of a rebound on the other way in the wardrobe refresh cycle, and also where consumers are putting their dollars, where more dollars are going towards experiences and services, fewer dollars are going towards goods, particularly discretionary goods, particularly among the younger demographic or that more aspirational demographic that has to watch their pocketbooks a little bit more closely. So again, this kind of points to the fact that, and you can see this too, you just turn on the news like CNBC for 10 minutes. A lot of what has been spent, especially over 2023, this is like last, 7-8 months. A lot of people have been traveling. A lot of people have been buying hotels. A lot of people have been buying services, especially since we've been locked inside for a couple of years. People want to do things that are outside. So it's not surprising. And again, when you could only spend money on clothes versus now you have money split between a lot of different things, people are spending less on clothes in order to spend on other things. So it's a matter of kind of getting back into that kind of fashion cycle and having people refresh wardrobes, which is what we saw last year. Next, we have Kunal said just to reconfirm, your return rate for the quarter was around 60%. That's what I'm estimating. So I just wanted to reconfirm that number. And then as we look at your average order value, the average order value has remained pretty firm. I was thinking maybe the average order value would decline simply because the mix of full price might be much lower. So how are you looking at the average order value for the rest of the year, and how are you thinking about that? So Jesse, again, the CFO, said first on the return rate, you are plus or minus in the right zone. That's a 50%, which of course is much higher than last year. We kind of addressed that earlier. Then on average order value, we're pleased with the average order value. It is coming in call it $1 or $2 lower than we had initially anticipated, and that's largely due to the softness of Forward, which of course carries a much higher price point than Revolve, but full price has come back. It's not at these levels of last year when we were checking out those record full price levels. It was 85% for the full year last year. We expect to be several points lower than that this year, but still at or above pre-pandemic 2019 level. So we feel good about the shifting back into the full price mix. Average order values holding despite some pressure from the mix of forward sales. That's a really good note to have the average order value stay put. It's just a matter of, can they get the orders for the 12 months? Can they, like this quarter, can they increase those orders in order to generate more net sales? If they can keep their customers happy and their customers that they currently have are happy paying $300, $250, in between that range for their product, obviously Forward pulls it up so people are paying above and below that average, hence the average. But to have that is pretty good. The return rate being high is something that they've probably talked over this quarter and last quarter, and even going into Q4 when they saw the tick up in that. A lot of it has to do with people are returning their entire order rather than keeping one or getting the wrong size and returning it or exchanging it. They're seeing kind of like a full-on return. One of the things that they are doing to address this is if a product like a shirt gets returned back to the fulfillment center, and normally what was happening is, like, let's say in Europe, it gets returned to either one of the European warehouses or somewhere in Asia, it's getting returned there. Rather than sending it back to the US to be redistributed, they're keeping that product there. Obviously, it depends, I'm guessing, on like the demand for the product. If it's a one-off shirt and no one else wants it, they're probably going to return it back to the US. But if it's an in-demand product, they're probably going to just keep it in the warehouse where it's at and just send it out when someone actually orders this product, which I think is a good efficiency. But their gist of this entire call was cost efficiencies and getting the cost down, or at least getting them to moderate. So that way, when they're building out things and they're, making these changes and, better increasing their company, it's not going to be weighing down on their financial statements. Last caller was Oliver Chen at TD Cowen, and Jonah for Oliver actually said, I'm curious more about international expansion plans. It looks like you're investing across different countries. How large these international trends are over time, and also curious on China specifically. How large do you think that the business can grow for both Revolve and Forward potentially? If you've seen any sort of noticeable differences in terms of customer demographic behavior in China versus the United States. Mike says, so long-term, I think international is a huge expansion opportunity for us. We would hope that long-term to achieve a third of sales or more, perhaps approaching 50%, but those are long-term aspirations. There's many steps from here to there. China in particular is a huge market where we feel like our brand hasn't penetrated in the same way as the US, but we feel like in the echelons of Chinese influencers who matter, we do have penetration, and we're really excited about the new head of Greater China that we brought on. That has a lot of operational expertise on the marketing side to help us out in that zone to really market the Revolve brand in a much bigger and broader way than we have historically. So that's a huge opportunity for us. Obviously, in China is an incredible, huge market for luxury and also aspirational luxury as well. So our hope is that over the coming years, we can grow into that huge market, but we'll keep you posted with our progress. This is the first step of many in terms of expansion of the brand marketing in China, and it's probably going to be 6 to 12 months before we start seeing some of the initial progress from those new steps. So again, when you're looking at a company like this, and this is the end of the Q&A piece of this though, but when you're looking at a company like this, it's not what's happening next quarter in terms of the growth. It's what's happening in a year from now, what's happening 2 years from now, and kind of where is the opportunity going to be coming from. And that's something that I'm learning more this year is it's not just value investing. It's not just buying something at good value. It's buying something that will grow, has a catalyst going forward that actually can push this company, moving forward. And I think that getting more international sales is a big piece of it. And when I had initially made this kind of purchase back in 2020 into Revolve, that was something that I had recognized, and it has grown ever since. I don't think I thought China would be as big of a market for them as it seems like now, but I think that, again, you can be like approximately right or analyze it to death. But I think that for me, the way I understand this and the way that like the quarter happened, I wasn't too stoked about the financials, obviously. Obviously it could always be better, but as far as what their talking points were, what they were referring to, what they were focusing on, I liked where the management's head was at. And again, I love Mike and Michael, but I think that my feelings about them aside, the responses to the questions were really good in this. It just, again, the financials and the macro are not playing into the short-term piece of this. So with that being said, let's look at the valuation. Let's see where we're at, and let's talk through it. And again, if you want to see, I do have shares of this. I sold a put on this. If you want to see more about that, go back a couple of videos to the portfolio review. Now, moving on over to the the whole thing, the whole reason we're here, the valuation and what my DCF says. Now, this DCF is based off of 7 years worth of data. Again, we're forecasting. There's a lot of error that's going to be built into this. And so again, I'm just trying to see, am I even in the correct ballpark? Am I somewhere close where I think this is reasonable? That's just really my focus in all this. So when you're looking at this, don't look as like fair value is $20. If you pay above it, it's the end of the world. If you pay below it, it's the best. Again, as things change, these are all assumptions built in. So I'm just trying to see, am I in the correct ballpark of where I think this thing could be? So looking at the outstanding shares, and I spelled outstanding wrong, we have 73 million shares outstanding. We have $1 billion in current revenue. And then obviously the current market cap was 1.249 billion. And current estimated free cash flow is 28 million, and the net income is 41 million. So looking at those ratios, 30 and 43, that looks really bad. But as we mentioned earlier, there's a lot of things that are built into these numbers that are either one-off expenses like the accrued legal expense that they had at the beginning of this year, or you have stuff that hits free cash flow like capital expenditures or other stuff like that, where it's more so one-off things that are big. So I don't know if the current PE and current free cash flow are really like that, but it's something that I wanted to note when you're looking at this, because again, their margins are getting hit by the macro, so that's going to impact going forward. Looking at the kind of assumptions, revenue growth rate on the low end, 5%, on the high end is 10%. Profit margin on the low end is 4%, on the high end is 7%. Free cash flow as a percent of revenue is 6%, and it is a high of 8%. So you can see on the left of that table, though, the current free cash flow as a percentage of revenue is 2.68%, and net income and the net income margin is 3.82%. So my assumptions are a little bit above where they're at currently, and that's something, again, that I want to point out. So looking at the terminal PE and the terminal price of free cash flow, you can see 17, 20, 23. I think that's reasonable. The discount rate is 12.5%. Going below that, you can see that the fair value in all of this is $20.36. The current stock price is $17. I have a put that I sold at $22.50. I got almost $5 and some change. So my actual buy-in price for that would be about $18. And then I bought some shares as it dips towards $16.15 range. So you can see on the numbers in the bottom left, the best and worst case scenarios, what the price valuations would be based on the assumptions that you see on the right side. And the thing is, again, I think that the case for the company is somewhere between the worst and best base case, and that's how I like to see it. So to see that the base case for the net income is $16 and the base case for the estimated free cash flow is $20 makes me feel a little bit better. I think that overall, if I can continue lowering and dollar cost averaging into this, I think I'll be fine over time. But again, this is something that you want to pay attention to. I think that what does it for me is the financials of the balance sheet. They have a lot of cash on the balance sheet. They don't have any long-term debt. Obviously, this last quarter had negative free cash flow. Net income wasn't that great. But I do think that over the long term, it'll go back to kind of a more normalized rate. And we'll have to kind of see where that goes. But for me, when I see that, when I kind of see the balance sheet is okay, I don't think that we're taking any crazy risks. As far as balance sheet goes, the financials are sound. It's more so just the macro and how does that impact. So that's been something I've been kind of looking at on the consumer side, is looking at other companies' earnings reports, looking at other companies and seeing what they're saying. Companies like Louis Vuitton are mentioning the macro and mentioning the short-term headwinds that they're facing as well. So this is not just a Revolve problem. It is a kind of luxury brand, retail branding issue that we've been seeing across a lot of the other companies. So again, macro aside, I think that this company is sound. I think that they're going to do well. What they'll do in the future, it could go up, it could go down. They might go bankrupt. They might, be the next $10 billion company. I don't know. I can't forecast that. I can only invest into companies with a good margin of safety or try to invest at less than fair value, or what I estimate fair value to be. So overall, though, I like this company. This earnings was meh at best. I think that they have a lot of opportunity to grow from this, and I think the international expansion will be a big piece of that. So with that being said, thank you all for joining me today. I hope you learned something. I hope that I was able to showcase a little bit of what we do here on the channel. I hope to see you in the next video. And with that being said, have a great day and happy investing.